The IRS has officially announced the updated 2026 tax brackets, and these changes directly affect how your Social Security benefits, Roth conversions, investment income, and overall retirement taxes will be calculated. Without a clear strategy before these updates take effect, many retirees could unintentionally give the IRS hundreds or even thousands more in taxes. So in this video, we're breaking down every major update using practical before and after scenarios designed specifically for near retirees and current retirees. Let's jump straight into the details. First, what exactly is changing in 2026? We'll begin with the increase to the standard deduction, which most retirees rely on. In 2025, single filers receive a deduction of $15,750, married couples get $31,500, and heads of household receive $23,625. But in 2026, those numbers rise slightly. Single filers move up to $16,100, married couples to $32,200, and heads of household to $24,150. That's roughly a 2.5% bump. For retirees age 65 and up, there's an additional age-based deduction. In 2025, single filers and heads of household get an extra $2,000 per qualifying taxpayer, and married couples filing jointly, separately, or as surviving spouses receive $1,600 per qualifying spouse. In 2026, both categories get a modest $50 increase. That means single filers and heads of household receive $2,050, and married couples receive $1,650 per qualifying spouse. Putting this together, a married couple over age 65 would receive the base deduction of $32,200 plus $1,650 for each spouse, bringing their total deduction to $35,500. But how much does this really save? Compared with 2025, their total deduction increases by around $800, even using a 22% tax bracket that only saves about $176 in federal taxes. So while the 2026 standard deduction increase is helpful, it's not something that will significantly transform anyone's tax situation. But the next changes absolutely can. Now, while the majority of Americans take the standard deduction, retirees who itemize, especially those in high-tax states, will want to pay close attention. The state and local tax, SALT, deduction cap has expanded dramatically. The previous limit was $10,000 per year, which restricted higher-income earners in states with steep property taxes or state income taxes. But under the new update, the cap increases to $40,000 for single, married, and head-of-household filers. However, phase-outs begin when your modified adjusted gross income goes above $500,000, and the enhanced benefit fully disappears at $600,000, returning you to the original $10,000 cap. This means that retirees with substantial property taxes, state income taxes, mortgage interest, medical expenses, or charitable contributions could find itemizing beneficial again. But remember, you only benefit from itemizing if your deductions exceed the standard deduction. Since the standard deduction has also increased, running your 2026 return both ways is essential. For many households, especially in high-tax areas, itemizing may now provide thousands in added tax savings or reduce what you owe. Next, let's discuss one of the most impactful updates for retirees: the new senior deduction, rolling out from 2025 through 2028. At first glance, it seems like a huge win, a bonus $6,000 deduction per person, age 65 and older. Even better, this deduction applies whether you take the standard deduction or you itemize, and it stacks on top of the existing age-based deduction we covered earlier. For example, a married couple where both spouses are over 65 could combine the $35,500 standard and age-based deduction with an additional $12,000 in senior deductions for a total of $47,500 in deductions. But here's the catch: this deduction phases out quickly, especially for retirees with solid income streams or those living in high-cost areas. For single filers, the phase-out begins at $75,000 of modified adjusted gross income, reducing the deduction by 6 cents for every dollar above that threshold. This means the full $6,000 is gone once income reaches $175,000. For married couples, the phase-out begins at $150,000 and wipes out the entire $12,000 benefit once income hits $250,000. This is particularly frustrating for married couples, since losing $12,000 of deductions can significantly change your tax position. This makes careful planning, especially around Roth conversions, even more important than before. If your conversion amount pushes your income beyond the phase-out, you effectively trade away this valuable deduction. Next, let's move into the ordinary income tax brackets for 2026. For single filers, the brackets are 10% up to $12,400, 12% up to $50,400, 22% up to $105,700, 24% up to about $222,000, 32% up to about $256,000, 35% up to around $641,000, and 37% above that. Many taxpayers misunderstand how this works, so let's clarify. The U.S. uses a progressive tax system, meaning your income is taxed in segments like filling buckets. Each bucket has a limit. Once the first fills, any additional income spills into the next bucket, taxed at a higher rate. So someone earning $100,000 doesn't pay 22% on the entire amount. They pay each rate only on the portion of income within that bracket range. For married couples filing jointly, the bracket thresholds nearly double. 10% up to $24,800, 12% up to about $101,000, 22% up to around $211,000, 24% up to approximately $404,000, 32% up to about $512,000, 35% up to about $769,000, and 37% above that. Compared to 2025, the percentage rates stay the same, but the income thresholds grow by roughly 3%. For example, the 12% married filing jointly bracket increases from $96,950 in 2025 to about $100,800 in 2026, giving you room for an additional $3,850 of income before moving into the 22% bracket. That alone saves around $385 in taxes. While that may seem small, remember these increases happen across every bracket, compounding the benefits. Next, let's shift to the long-term capital gains brackets, which operate differently from ordinary income brackets. Many retirees are surprised to learn that paying 0% tax on long-term gains is still possible if you understand the limits. A long-term capital gain occurs when you sell an investment after holding it for more than a year. If you sell it before a year passes, the gain is short-term and taxed as ordinary income. In 2026, the long-term capital gains brackets for single filers are 0% up to $49,450, 15% up to $545,500, and 20% above that. For married filing jointly, 0% up to $98,900, 15% up to $613,700, and 20% above that. Heads of household get 0% up to $66,200, 15% up to about $579,600, and 20% beyond that. But here's where retirees often get caught. These thresholds consider your total taxable income, including ordinary income like IRA withdrawals, wages, and interest. So if your ordinary income alone exceeds the 0% threshold, your long-term gains automatically jump to 15%. However, and this is crucial, long-term gains do not push you into higher ordinary income brackets. The interaction works only one way. Also keep in mind that states often tax capital gains exactly like regular income, meaning even if the federal tax rate is 0%, your state may still impose taxes. To avoid surprises, model your gains ahead of time, spread gains across multiple years, or use tax loss harvesting to offset taxable growth. Even though many areas of the tax code adjust annually, some of the most impactful taxes do not adjust with inflation. First is the net investment income tax, NIIT, the 3.8% surtax that kicks in once a married couple's modified, adjusted gross income exceeds $250,000. That threshold hasn't changed since 2013, so more retirees fall into it each year simply due to rising incomes. Second is the taxation of Social Security benefits. If your provisional income exceeds $25,000 single or $32,000 married, your benefits become taxable. Go beyond $34,000 single or $44,000 married, and up to 85% of your benefits can be taxed. These thresholds have also been frozen for decades, effectively raising taxes on retirees year after year. Strategies like qualified charitable distributions for those over age 70 and timing income carefully can help soften the blow. Finally, let's talk about one of the most overlooked retirement penalties, IRMAA, the Medicare Premium Surcharge. Many retirees don't realize that Medicare premiums are based on income from 2 years prior, so your 2026 premiums are determined by your 2024 income. According to the expected thresholds, if a single filer had a modified adjusted gross income above $109,000 in 2024, or a married couple exceeded $218,000, they'll face increased Medicare Part B and Part D premiums. And these surcharges rise steeply the higher your income climbs. Unlike tax brackets, IRMAA works like a cliff. Exceed a threshold by even $1 and you pay the full next tier premium, no gradual increase. This is why retirees must include IRMAA planning in their tax strategy, using approaches like staggered Roth conversions and income modeling to avoid costly surprises. With the base Part B premium in 2026 projected to be about $226 per month, getting hit with extra charges adds unnecessary financial stress. Now that you understand how the 2026 tax changes can quietly drain thousands of dollars without a proactive plan, what if you could fully reverse that effect? What if you could legally pay zero tax on six-figure retirement income, even without a Roth IRA? In the next video, I'll walk you through a real-life case study where we helped a retired couple keep $120,000 of income completely tax-free under the updated rules. Click over to that video next. And before you go, make sure to hit subscribe. Tax Hack Pro, and we help you legally keep more of your money in retirement.